This chart has been signaling that the United States is poised to enter an economic downturn for the last year. Every time that the yield curve has been inverted, it was followed by a global recession with very few exceptions. But the economy hasn't crashed yet as the yield curve predicted it would. This black line here are economic indicators that are showing if the US economy is growing or contracting against the yield curve that is advanced by 12 months. And so you can see basically the yield curve is supposed to predict where the US economy is going next over the next 12 months. And today it's telling us that the economy is meant to be crashing right now into a recession, just like every other moment on this chart where this red line, so the yield curve was below zero, so being inverted. In almost all of these instances, it predicted that the US economy would be crashing in the 12 months ahead. And in mid-2023, I used this as a signal to anticipate that the US economy would likely begin to enter a downturn, which, as you can see from this chart, hasn't materialized. The idea being that S&P 500 earnings would actually decline during a downturn, which is what has happened in every single recession over the last 30 years. And just like it did in 1990, in 2001, in 2008, in 2020, it would drag the S&P 500 lower. Now, as you can see over the last year, we haven't seen stock market earnings decline. In fact, they're still around the same level they were towards the end of 2021. And in the meantime, we've seen the stock market move significantly higher during this period of time, exceeding its previous all-time high in 2021. So this has been a mistake on our end, underestimating the potential for earnings to stay flat, for the economy to stay strong during this period, and for investors to anticipate that the economy is going to avoid a downturn altogether, because the economy is not showing the same warning signs today as it was at the peak in 2007 or at the peak in 2000. Back then, we had initial jobless claims that were curling upwards before the economic downturns actually materialized. This was telling you that people were losing their jobs during these periods and increasing the probability of seeing an economic downturn materialize. That's not something that we're seeing today. Today, initial claims are still trending lower, not telling investors that the labor market is beginning to crack and that a recession is imminent. So does that actually mean that a recession is not going to happen? No, of course, initial claims could begin turning higher today and begin to scare investors out of the market, just like it did in 2000 and 2007. Now, many people don't understand how that could actually happen because there seems to be no catalyst today that could trigger a rise in initial claims. But believe it or not, in 2007 and 2000, this also came out of the blue. There was no clear reason why people were losing their jobs. It was just part of the business cycle. In fact, when we look at the number of stories that have the term soft landing in it back in 2000 and 2007, or right before the recessions happened, you had a spike in the number of these stories where traditional media was very quick to adopt a soft landing narrative before we actually knew for sure whether a recession was going to materialize. Today, despite most media outlets considering that we are in a soft landing, so the economy having avoided a recession, it is still too early to say if this is actually going to be the case. When we look at a simple chart of the US unemployment rate and we track it against the yield curve, we still see that there's a perfect relationship between the two, and that when the yield curve steepens out of an inversion, that's typically accompanied by a rising unemployment rate. And while we have seen some steepening today and no real reaction from the unemployment rate yet, it is still too early to say whether a steepening in the yield curve today is not going to cause a rising unemployment rate just like it did in previous recessions. In fact, we still strongly believe that that's going to be the case, and that when this does happen, it's going to be accompanied by a lot of volatility on the S&P 500. However, the truth of the matter is that the yield curve has been inverted for the last year and a half, and that the unemployment rate has stayed low, and the economy has stayed strong. We can compare that to 2006, where the yield curve stayed inverted for around a year and a half, and the unemployment rate stayed low during that period. The same thing happened in 1989, where the yield curve inverted for quite some time, and the unemployment rate stayed low during that period as the economy stayed strong. In both of these cases, the stock market rallied despite the yield curve predicting a recession at those moments. And anyone betting against the stock market rally in anticipation of a recession at those moments was much too early, even though recessions did end up materializing a year and a half later. And we've been early calling for a recession over the last year, and being early is the same as being wrong when it comes to macro. Because in the meantime, the stock market has broken out of a massive basing pattern, and it's undeniable that the S&P 500 is in a solid uptrend with moving averages that are pointing upwards and showing strong momentum. In the near term, however, the stock market is beginning to show signs that it's overextended and that it's very likely vulnerable to at least a temporary pullback, just like it was in August of 2023, because we're seeing something today that we actually also saw in August of 2023, but also in August of 2022, in March of 2022, and believe it or not, in November of 2021. Something called the put-call ratio is currently at a very extreme low level, which has coincided with all of these local tops in the market. Now, the put-call ratio is the number of call options versus the number of put options that are betting on the market. And so when it's extremely low like it is today, it's telling us that there's complacency in the market because there's a lot more people putting calls on the market rather than puts. In fact, you can do the exact same thing when the put-call ratio is very elevated, like in these instances, that almost systematically marks bottoms in the stock market because too many people are betting on more downside in the stock market rather than any upside. Of course, it's far from being a perfect signal. When we zoom out just a little bit more, we see this entire period in 2020 and 2021 where the put-call ratio stayed extremely low for an extended period of time. And despite that, of course, the S&P 500 rallied significantly during that. But this seems to be an exception because when we look at this period right here, we do see that most of the time, low put-call ratios correspond to moments where the stock market is making a top. Even the top of the market right before the COVID crash was accompanied by a low put-call ratio reading. Although again, one could argue that the put-call ratio was already low right here, and the stock market continued to rally in these complacent conditions, and the put-call ratio just got more extreme. We could argue that we're actually in a similar situation today where the put-call ratio has been low since January of 2024, and yet the stock market has continued to rally, leading to an even lower put-call ratio today. So this is not an indicator that we should use on its own, but we do have one more indicator that is flashing a warning signal for the stock market today, and that is the volatility index of the S&P 500, also known as the VIX. This is a chart of the VIX but inverted, and so you can see recently we've had a rising volatility, a rising VIX. And when we look at the stock market during this period, we've seen the stock market rise. That is a very unusual type of behavior because you can see on this chart, most of the time these lines are moving in the same direction. It's very rare that you see these lines move in an opposite direction. This is actually something that we saw at the very top of the market in 2021, where the stock market was rising, but volatility was also rising during this period. This is also something we saw leading up to the top in August of 2023 right here. The VIX, although less than today, was also rising during that period. This is telling us that volatility traders are betting that the stock market is going to go down, while investors continue to bid up the price of the stock market. And most of the time in history, we've seen that get resolved with volatility traders being correct. We still believe that the yield curve is going to be right and that a recession is not far down the road. The stock market is vulnerable to a pullback in the near term, but it doesn't look like it's about to put a massive stock market top here. We have lots of different trades to take advantage of today's environment. We recently initiated a long trade on a crypto called Solana for our members, and it's already up around 20% since we entered. Our one and only goal is to make sure that as many of our clients are profiting from markets as possible. You can test out our service for free if you're interested.